Credit risk calculation starts with three building blocks, which are number one, how likely a borrower is to default, technically called as probability of default, or in short PD. Number two, how much is at stake at that time, technically called as loss given default, or in short LGD. Number three, and how much you lose if default actually happens. Basically, amount that is actually exposed when default happens, not just today's balance, technically called as exposure at default, or in short EAD. It's okay if you are confused between EAD and LGD, as we will shortly look into many examples to clear the understanding further. So again, let's quickly revise what is credit risk. Credit risk is the risk that a borrower or counterparty will not pay interest or principal as agreed. Yes, it's not just principal, but if interest repayment is also missed, that is a credit event causing a financial loss to the lender or investor. Now let's look them in detail with examples. Probability of default, or just P. PD is the likelihood that a borrower will default over a given horizon, often 1 year. Example, PD of 4% means on average 4 out of 100 similar borrowers are expected to default in 1 year. How PD is estimated? Modeling of PD is not in scope of this video, but if you want a separate session on PD modeling, then do let us know. Just to touch briefly on PD modeling, banks often use historical credit rating to each borrower and then map internal credit ratings like AAA, AA or A, etc. and observe default frequencies. For example, rating B has 4.5% annual PD. Okay. Next concept is loss given default, or just LGD. LGD is the percentage of the exposure you expect to lose if default occurs after all recoveries. It relates to the recovery rate. LGD equals 1 recovery rate. Example, let's say loan outstanding at default is 10 lakh rupees. You recover 4 lakh rupees via collateral sale and collections. So recovery rate is 4 lakh divided by 10 lakh equals 40%, and LGD equals 1 minus 40%, which is equal to 60%. Okay. Now let's look at third parameter, which is exposure at default, or EAD. EAD is the amount that is actually exposed when default happens, not just today's balance. For example, for a term loan, EAD is outstanding principal plus accrued interest at default. For revolving products like credit cards or overdrafts, EAD must include possible future drawings up to the time of default. Example, if credit limit 1 lakh rupees and utilized at default 80,000 rupees, then EAD equals 80,000 rupees. Now that we have understood PD, LGD, and EAD, now let's use them in expected loss credit risk formula. EL equals PD times LGD times EAD. Now, let's look at numerical example of a single loan, and later we will look at a portfolio of loan. Suppose PD equals 3%, which is numerically 0.03. LGD equals 50%, which is numerically 0.5. EAD equals 10 lakh rupees then. Expected loss equals 0.03 times 0.5 times 1 million equals 15,000 rupees. It means on average, you expect to lose 15,000 rupees per year on loans with similar risk characteristics. Now let's look at portfolio level credit risk calculation. It is very simple. Basically, for a portfolio, you calculate EL loan by loan and sum all the individual ELs. For example, with 4 borrowers with characteristics as seen on screen. You can pause the video here and see if you are able to match EL calculation with ours, and feel free to comment portfolio level EL value you obtained. I will give hard to right answers so you get know if your answer is right or not. Okay, great. Now that we understood what is credit risk, how to calculate it, then next obvious question, why do banks do all these calculations and what benefits banks can derive from these calculations? Benefit number one is pricing. The interest spread must at least cover EL plus funding cost and profit margin. Higher PD or LGD means higher required yield. Let's understand what we mean by that. Suppose bank has lent 100 rupees to people that have internal rating of AAA with EL equals 2 rupees. Now bank wants to make 5% profit on its lending business. For simplicity, we are assuming no funding cost for now. So To make 5% profit, bank should lend at interest rate of 5% to make extra 5 rupees. Since bank knows EL is 2, so to make 105 rupees, bank has to earn 7 rupees from 98 rupees loan. So pricing becomes 7 divided by 98, which is 7.14%. With EL in picture, pricing changes from 5% to 7.14% for triple A rated customers. Let's extend this example a little more. Suppose bank has lent 100 rupees to people that have internal rating of double A with EL equals 3 rupees. Again, bank wants to make 5% profit on its lending business. Since bank knows EL is 3, so to make 105 rupees, bank has to earn 8 rupees from 97 rupees loan. So pricing becomes 8 divided by 97, which is 8.24%. With EL in picture, pricing changes from 5% to 8.24% for double A rated customers. Hope you can now visualize how EL can help bank price their lending as per the customer risk profile. Benefit number 2 is provisions under IFRS 9. Banks set aside provisions equal to expected credit losses till lifetime EL for risky assets. Let's extend above example a bit more. In above example, bank has total lending business of 200 rupees across triple A and double A customers and total EL of 5 rupees. So bank will have to set aside 5 rupees as provisions from its own money, which could be its past profits as in retained earnings or other form of capital like shareholder equity, etc. All right, everyone, that's all for this video. Hope you the concept of credit risk, its calculation, and its usage and benefits for banks is clear. If you have any doubts, feel free to ask your questions in comment section, and we will answer them as quickly as possible. Please do subscribe our channel for more such informative videos. Thank you and all the best.